So let's take a look at some other opportunities and examples of how to pair trade. So here's another example. This is relating QQQ, the NASDAQ ETF, to Aapl. Okay, so the coefficient or correlation here on these two are very highly correlated. So about 0.944. So you can see here QQQ, tight correlation, it goes up, Aapl goes up. So very tightly correlated together. But at times, these correlations will separate and change, right? So nothing always stays that tight. So here's a really great example. So this was back, if you look at this, we'll just kind of walk through this trade example or this spread. So this was back on about the 10th of May. Let me get my drawing tool here. So right where that blue line is. So the 10th of May. So this is then like long QQQ, short Aapl, okay? So look at the difference in the spread, what happens. So right here, you can see these are my momentum indicators on this spread, the cycle reversal indicator on the spread. So we get a reversal here on cycle, good momentum, and that spread starts to separate. Look at that trend up. Okay, so this is QQQ outperforming Aapl. All right, so this is from May 2023, and really huge outperformance. And just looking at tracking that moving average. Now it comes up here, and finally, this was last week. This was on Thursday, right there. That was on the 17th. So from the move here at basically 150, at that point, QQQ was $150 over per share over Aapl, all right? And then that spread, what did it do? It widened. And then on Thursday of last week, that spread right here was trading at now, at that point, it was 185 over. So that spread went from 150 over to 185 over, okay? So that is a $35 per share increase in that spread, or per 100, that'd be 3,500. Okay, so you can just think of the potential opportunity. And then if you were doing synthetic options, if you did one option contract, long short, you would have made 3,500. So let's say you did 10, you make 35,000. So this is how hedge funds and proprietary trading shops make huge amounts of money on spreads. And the other thing is the margin requirement for spreads is a lot less than if you just go long or you just go short. So that's the other big benefit. So that's a huge move, right? So the other thing here, look, and we'll go through the chart here in a second, but the other thing you'll notice is right here, where that yellow line is, there's a big surge. You can see here it dipped down, it came to 183, and then all of a sudden it had that huge surge to 196. And that's when Aapl just really collapsed to the downside, okay? So that's a beautiful movement. Now that's the 4-hour chart. So I like to use a 4-hour with the daily. So over here's the daily, you can see the bigger picture. So here's the daily. So we have momentum shifting up. So that's positive price momentum. Here's our cycle reversal right here. So this was back late April that started to churn, and then here got confirmation with momentum, and that spread took off and held the 21 exponential moving average all the way up. And then you had this final surge right here. Now that's when Aapl collapsed, okay, and that spread blew out. So from that point, that was on the August the 7th right here. So at that point, it went from here up to 196, and that was a move of from here, that was $46 from here to there. I mean, that was a huge move. So that's the great thing. So that was actually a $14 per spread per share move right there. So that move right here on 100 shares was $1,400.